12% of consumer media time is on mobile and just 3% of the budgets. And we think we offer by far the best opportunity to reach consumers on mobile. Facebook gets 1 in 7 minutes on the desktop. We get 1 in 5 minutes on mobile, so a greater percentage.
That was Facebook COO Sheryl Sandberg in an exclusive interview with CNBC talking about the success Facebook has had on mobile. But with the company now sporting a market cap that is 3 times greater than Time Warner, could the stock be too expensive? Let's talk numbers with tech guru Dan Niles of Alpha One Capital Partners. Dan, welcome to the show. And let's get right into it and start with Facebook. Does its growth in mobile justify the company's sky-high valuation?
Well, I think you have to actually look at the valuation relative to its growth rate, and what I would tell you is that their valuation is actually pretty good. If you look at Time Warner, which was the example I think you brought up, their revenue growth in 2013 was 4% year over year for their revenues. If you look at Facebook and their growth rate in 2013, their revenue growth was 55%. And it actually accelerated from the March quarter of 2013. It was 38% year-over-year growth. And then based on some of those trends that Sheryl Sandberg talked about, that revenue growth accelerated from 38% in March to 53% in June, 60% in September, and 63% in December. And we think actually a big opportunity lies ahead as they move into video advertising, which they really don't get much revenues from today.
Right. Now, aside from mobile and video advertising, where are the other growth opportunities for Facebook? I think that's one of the big questions on the street.
Well, I think you really actually have to go back to video because they haven't really started any revenues in video. And you have to remember last year they did about $7.9 billion in revenues for Facebook. They did just over $100 million or so is our estimation in video. And if you look at the video advertising market, to give you an idea of size, in 2013, total advertising globally was about $700 billion. TV advertising out of that number was about $240 billion, and in the U.S., it's $80 billion in size. So if you think about that opportunity to go from over $100 million in revenues for Facebook to pick up some big chunk of that $80 billion just U.S. market and then eventually the $240 billion TV market, that's where the big opportunity is. And they just started exploring a lot of that in Q4 in that they launched some advertising on Instagram and they started testing video ads on the Facebook platform with brand marketers in Q4. And I think that's the big driver for the next couple of years is moving into video.
Got it. So video is the name of the game for Facebook. Now let's also talk broadly about the new internet stocks. Here's the performance of tech stocks since their IPO. Pandora is up 70%, Zillow up 162%, Yelp up 435%. So other than Facebook, those companies don't make a ton of money. What do you say to critics who argue we are in another tech bubble, Dan?
Well, I think to some extent that's true because last year, if you go back and you look at it, it almost didn't matter what stock you were. Your stock did well. And so to give you an example of that, look at Twitter, right? Twitter last year, before they ever reported the current quarter, their subscriber growth year over year, to give you sort of a history of this, in Q3 of 2011, it was 106%. Then in Q3 of 2012, that had slowed to 65%. And in Q3 of 2013, that subscriber growth had gone to 39%. So before they ever reported this last quarter, you already knew their subscriber growth was slowing down a lot. But it didn't stop the stock from going up over 50% in the month of December as everybody just was excited because the stock market, the S&P was up 30% last year, and people know what Twitter is. They see it on TV, and so people get excited. They don't care about valuations. And so, last year you had a lot of these situations where Amazon missed 3 out of 4 top-line quarters. That stock was up 59%. Google last year missed 3 out of 4 top-line quarters. That stock was up 58%. And so last year, investors with the market up 30% in general, there was really no focus as much on valuations or fundamentals. This year, obviously, the market started off a lot rockier. And so what you're seeing this year is you're starting to see some differentiation where if you're Twitter and you remind people, hey, my growth is slowing, people are punishing that stock versus a Facebook, their revenue growth is accelerating, people obviously rewarded that. And that's, I think, the biggest difference between this year and last year.
Great. Dan, thanks so much for your time. We'll continue to keep an eye out on those high-flying internet stocks. That'll do it for us on Talking Numbers. Make sure to follow us on Twitter at CNBC Numbers. Like us on Facebook for Talking Numbers. I'm Seema Modi.